Previously, we discussed the boom in U.S. natural gas production and how that's contributed to a collapse in natural gas prices that, of course, has been tremendously beneficial for consumers of natural gas, both in the United States and with the advent of LNG exports from the United States, consumers all around the world. However, the collapse in prices for natural gas has not been beneficial to everybody, least of all not the natural gas producers, who are sort of the bust within the boom of natural gas production. In the United States, shale production comes from 7 major regions, of which Appalachia, the Permian Basin, and Haynesville in Arkansas are the most prominent. Now, what all 7 regions have in common is collapsing capital investment and plummeting rig counts across every region. Presumably, the recent natural gas and crude oil sell-offs will put further downward pressure on capital investments in the sector. Amid the bearish price environment, producers have been pursuing a variety of different restructuring strategies. Some of them have relied on raising capital through debt, which allows them to keep producing for even longer. Unfortunately, the low price environment has eroded equity valuations, amplifying the problem of holding uneconomic assets and pushing some companies to write-offs, fire sales, financial distress, and even bankruptcies. For the moment, the decline in capital expenditure has had little impact on production amid soaring productivity per rig. Now, soaring per rig productivity, however, provides a distorted picture of where U.S. natural gas production may be heading. If one takes off all of the exploratory rigs and draws them offline, the rig count declines while production continues apace from rigs that have already been successfully deployed. Now, the average shale gas well, however, lasts for only 18 to 24 months. Eventually, per rig productivity could begin to decline. If that happens, the combination of low rig counts and falling productivity could cause U.S. oil and natural gas production to begin to fall. Falling U.S. production could in turn begin to reduce very high storage levels and allow prices to drift somewhat higher. But it is important to point out that even if U.S. prices were to drift somewhat higher for natural gas, U.S. prices would still remain very, very low compared to international prices like those seen in Asia and Europe. And it's very likely the U.S. LNG exports could continue to thrive even if prices rose, say, 25 or 50% or more. I'm Eric Norland, Senior Economist with the CME Group in London.